Welcome to the final bar. I'm Greg Schnell, stepping in for Dave Keller. He is away from the office this week. So I want to thank you for taking the time to join us on the final bar. We got lots to cover off today. It was a pretty good week. As we can see, the index is ramped up into the close, making a very nice run for the roses here. So we finished at all-time highs. Pretty strong move. We got lots to talk about today. I want to break our show into a couple of different parts. I do want to cover off a little bit of a Sesame Street situation where one of these things is not like the other. We're going to cover that off in the breadth category. The other thing I want to cover off a little bit is about interest rate and gold and how that's fitting together. It's changing quite a bit lately, and all of a sudden the gold stocks are starting to pop. So I want to cover that off. And for our 3 and 3 today, I've got a couple of high volume charts that I want to show you. And then I want to wrap it up with another chart from a different area that all of a sudden that whole industry group is starting to move. So we're going to jump into that. Lots to cover off. Anyway, let's jump into the show. So to start it off, first of all, we can see that the markets all had a big run into the close, like literally in the last hour, everything just went vertical here. So a very nice push. And on the S&P 500, we can see, you know, we trended higher for the last 2 weeks here, just pushing right up and finishing in the strongly up in the top right-hand corner. I would almost call it an exhaustion surge, just because it's been such a straight up move for 10 days here. But looking on the weekly chart, everything, you know, is in trend. I'll call it, albeit an aggressive trend higher. We are trying to break out of the little sideways period we had going there from mid-February to late March. And now all of a sudden, the last 2 weeks, we've definitely seen a big move higher. When we get into the Nasdaq, a little bit different. It took us a few days to get going, and then a big surge all week here, and then another big push on the Friday close. So that also looks pretty good. Looking on the daily chart, you can see the Nasdaq is testing. I'm trying to get my screen to magnify. There we go. Testing the final high here. So this is our highest closing high, not our highest intraday, but by far our highest closing high. So that looks pretty strong. When we talk about the Nasdaq, though, I do want to point out that as we hit this higher level here, we've got a little bit of discrepancy in some of the breadth data. So I want to take the time to show you that, because that's about the only fly in the ointment that I can find right now. Everything else looks relatively bullish, and things seem to be working their way higher. On the weekly chart for the Nasdaq, the bigger issue that we have here is we have lower highs on momentum indicators, and I mean that's been that way since September, so not really something to worry about immediately. I would say that it looks like all the mega caps are running here. Apple, Amazon, Facebook, Google, Microsoft have all started to make a nice push here. But what we see is as those are pushing, we're not getting the same sort of breadth. That real push is probably what concerns me the most. Let me just scroll up to the top here. I briefly want to cover off the Canadian market. Now, one of the reasons I like to cover off the Canadian market, especially on Fridays, is it tends to be a commodity-related market and can also give us some clues of weakness, and we don't really see that yet. You can see that we've also, in Canada, and I'm recording from the middle of the Rocky Mountains today, we're pushed up and to the right here, stuck in the top right-hand corner, very strong finish. On the daily chart, everything looks fine. You can see that the PPO oscillator momentum indicator, just keeping track of how much force there is pushing us higher, has been pretty much continuous all the way since the beginning of the year, oscillating in a range around 0.5% to 1%. So pretty good, nothing really to complain about there. And on the weekly chart, remember on the NASDAQ, I noticed that it was making lower highs since last September in terms of momentum, and we're just trying to, well, we did hit a new closing high today. The big thing is we've got a lot lower momentum on that tech index, whereas the commodity index, I'll call Canada a commodity index, has pushed higher, finished in the top right-hand corner, so commodities are still doing okay. Looking just across the sectors today, I'm just going to update this to get the final close. This is uh, the way we finish the week, and I've got a couple of so this is sectors, but I've also got just three other charts in this list. So I've got energy, exploration and production, I've got semiconductors, and I've got retail also poked in here. But we can see retail continues to do well, falling into consumer discretionary for the most part, really, really strong. That was kind of one of the better areas of the market this week. Semiconductors actually took a week off after being very, very strong for the last 2 or 3 weeks. So to have it coming in at, well, these are intraday. Let me get to 1 week. I was like, that doesn't seem right. Okay, there we go. So here's our 1 week, and we've got technology at the top. Coming in better, but semiconductors, again, they've been leading for the last 2 or 3 weeks, and now all of a sudden they're near the bottom in terms of performance. Energy was very weak, with the exploration and production stocks off hard, down 8%. Technology, and again, a lot of this comes through in some of the big tech names. They've been leading us up lately. Consumer discretionary has been very strong as we come out of the pandemic with the vaccinations. Communications, both Google and Facebook have been doing well, so those charts are nice. And again, retail topping up the list. All of that adds together to a pretty strong week. Nothing wrong with that. If we go up to Canada as a commodity country and just quickly look at the list, we see technology led there as well. Gold miners were up quite nicely this week, and that's one of the reasons I want to cover it off. Looking down at the bottom here, healthcare typically represented in Canada by marijuana because most of the healthcare is government. Staples down near the bottom of the list. So again, we still have a growth-sided market in Canada as well. I will say that the big pullback in energy wasn't quite as severe as it was on the US side, but nonetheless, it was still down on the week. Looking around the world, big area here. Nasdaq was the top performer. This is as of Thursday's close, so we won't get the Friday update on a lot of these indexes yet. But in general, around the world, we were positive, so it was a pretty strong response. And when we looked at commodities for the week, some of these will be stuck on Thursday as well. You can just see lumber still having a banner week, up another 10%. I actually thought it might double top, but it continues to push higher. Precious metals were some of the best performing areas of the market this week, and that's a pretty strong showing. Looking in on copper, copper continues to push up. The old high, I think, if I'm not mistaken, is around 460. So sitting at 410, it wouldn't take much to take out new all-time highs in copper, roughly a little 10 or 15% higher from here. The gold and silver miners outperformed silver and gold. That's usually a positive sign for things going higher when the miners are getting more love than the actual raw metal. And looking at what didn't perform, it was pretty much liquid energy, crude oil, gasoline, heating oil. So all of these were weaker on over the period. And when we looked in steel, which has been buzzing, it's just been going crazy, had an average week just flat, and then lithium down slightly. Rare earth metals were still up. So we still have I'll call it the enthusiasm for the infrastructure trade with steel, rare earth metals, copper moving higher. Wouldn't mind seeing lithium join that party again, but that lithium chart's been a great one for the last year or so. Okay, that kind of covers everything from that perspective. The next thing I want to get into is the breadth discussion, and there's a specific reason I want to get there. On the breadth area, when we look at, missed my tab here, sorry, there it is. Okay, when we get into the breadth area, the one thing that I notice that I'm not that comfortable with is we see the NASDAQ advanced decline line. This is fresh for today. So we pushed up to new highs, but the problem we have here is we're making lower highs on this indicator. And what does that mean to us? So advanced decline is the number of stocks advancing minus the number of stocks declining. And then we make a cumulative total. So we keep adding it to the day before. And typically as we break out to new highs, we either want this advanced decline line indicator to keep up with the index or to actually outpace it, where advancers are actually pushing higher, even though the market hasn't quite started to follow along yet. When we get that sort of clue, that's really bullish. The problem we have now is we're getting almost into the 2-month mark. Monday will be 2 months from the February high, February market top high on the Nasdaq composite. And what we're looking for here is we want to start to see this indicator surge. And the real issue we have is it's the only index that's really not pushing higher. So we're starting to get some weakness in the Russell as well, but I would say the big ones, S&P and the Dow, small caps and mid caps, have been performing pretty well, and I'll show you those charts in just a second. So notice this shape here of the lower highs on the Nasdaq advanced decline. Now I'm just going to take it down to the New York stock market. So the New York composite is shown at the top here, and you can see that's been pushing up into the top right hand corner. And look at the advanced decline line difference between the Nasdaq and the New York composite. This is pushing up very, very strongly. So everything that I see on this chart looks very bullish and normal. And again, it's that divergence with the Nasdaq that makes me a bit uncomfortable. I have no other data that's really giving me a, be cautious here sign. So I want to keep monitoring that. But here's an example of just the new highs. So again, we're just looking for stocks making new 52-week highs. And what we're seeing here is on the NASDAQ, so this NAHGH is the NASDAQ, we're actually making lower highs over the last week. When we compare that to the New York Stock Exchange, we're making higher highs. So really quite a divergence in behavior here. And then for the NASDAQ stocks making new lows, we're down here around the lows, so that's not too bad. But interesting, the New York stock market actually started to kick up a little bit. So we've got a little bit of room to play here, but really this is the question mark, is as the stock market's hitting new highs, why aren't more stocks doing that? So on Monday, we had almost, call it 270 stocks. And on Friday, we only had 100, even though we were pushing to higher levels on the index overall. So quite a bit less participation as we ended the week. This is a chart originally built by Arthur Hill, and I've continued to use it over time. I like it when it loads all the way. What we see here is this is the S&P 1500, so not the 500, but 1500 that keeps track of the S&P 500, the mid cap and the small caps. What you see here is this is pushed up to a new high. We're a little bit lagging here just the last couple of days. Now I could always give it a few days, but I do want to see this start to accelerate again and push up to new highs. When we get into the mid caps, what we can see is we're getting very close to testing this trend line. We're still okay, but again, we're making a little bit of a lower high so far. And again, you're going to have a pullback and then try to climb out of the hole. As you climb out of the hole, what you want to make sure of is as the market goes higher, so does your advanced decline line. In this case, the advanced decline line is actually higher than it was in the middle of March. And the index is still lower. So this is still pretty bullish, pointing us to higher ground because the advanced decline line is outpacing the index itself. Now, when we look at the small caps, so on the small cap indicator, what you can see is I've got this trend line here, and we could redraw the trend line if we wanted to. I think the bigger thing to focus on is what's going on. We have this uptrend in the advanced decline line, and it's coming down very close to what would be this extended line. And I made the mistake of drawing this out earlier and then forgetting to save the chart. So just we'll just work together on this to show you what I was trying to say. This red line here, what I want to see is that it holds this red line and continues to move higher. Now, up here, I could take this chart and actually set it up, call it, put a more gradual slope on it rather than using the November low, just put kind of the 5-month trend. Either way, we're a little bit close on these lines here, and we want to start to see this push up. You can see we're meaningfully below the middle of March highs. So as we come out of this, let's watch and make sure that all of the markets start to participate. We don't want small cap and the Nasdaq to start to underperform. That would probably tell us that the market needs a little time to relax at least. There we go. Okay, so that's one of the areas that I think is important to watch. And again, nothing really fearful. It's just the fact that for some reason we're starting to see weakness. Now, when we look at the high-low data, on the high-low, what we can see here is that the number of stocks making new highs on the Nasdaq is almost zero on a cumulative basis here over the last few days. You can see it down here in the bottom corner. Only a 2-week moving average shows it very weak, even though we're right near the all-time highs. And then when we go to the New York Stock Exchange, this one's looking a little bit better. It's at 146, and you can see that, of course, the market's pushed on to new highs. So it's not uncommon for it to wobble. We just need to make sure it continues to rise up. We don't want it to kind of make a high and then a lower high right in here while this continues on. That's usually the kind of thing that gives us pause. Other than that, I see the opportunity for breadth to the upside being very, very strong. Looking in on the gold segment, I think the strongest thing to appreciate there is we have a stock market that's been going higher without gold for a period of time. And the reason that I think gold is important, one is a little bit as an inflation barometer, but there's another chart here. And if we understand what it means to invert a chart, what I've done here is I've shown the bond yield for the 10-year and the gold chart. And what you see is the movements, I would say, are relatively similar. Here, the yield kind of took off. I've inverted gold so that if I was to show it normally, what it would do is almost look like a mirror image of the bond chart. So this is the gold miners. What you see here is that when the bond yields go up, the gold miners fall, and when bond yields are falling, it was pretty good for gold, and that pretty much held all the way from 2018 to the middle of August. Now, we all have heard the talk about the sudden rise in yields, and really at the beginning of the year, in January, we started to break out of this base in bond yields and took off to the upside. Gold also really started to meaningfully pull back from that period. But I will say the one place where, everything lines up very clearly is pretty much right on the high. As the yields bottomed, gold topped. And now we're all convinced that bonds are going higher in interest rates, lower in bond prices. And typically what that would say is more weakness in gold. Now, the question for that is, the bonds we can see got up into the middle of kind of the area they were in 2019. What's happened for gold here is as bonds have hit resistance, the gold stocks have actually started to take off to the upside. And again, I'm using GDX here, which is the ETF tracking gold miners, not the ETF tracking the price of gold. I can change that. It doesn't matter a whole bunch, but when we look at the GLD chart, what we can see here is the movements are a little more muted. The gold chart, the gold miners seem to have a more enthusiastic response both ways. Okay. Anyway, my point would be that as long as the bond yields are stalled here, it looks like a nice time to get on board with the gold miners. And I mentioned it in the opening comments when we started to look at the actual summary for the market for the week. The gold miners outperformed gold pretty handily. And as well, we didn't get much price action in the bonds. So while bonds paused, the gold miners actually had a pretty strong week. So again, I'll just go back to this chart and change it back to GDX. So I know everybody expects the bond yields to go rocketing higher. I will say that the 30-year bond. So if we look at the TYX, just notice how on the 10-year so far compared to the late 2019s, the bond yield has not got up to that level. When I change this to TYX, which is the 30-year bond yield, we've made it up to this level, and it's pretty much been a resistance area. So if bonds are on hold for a month or two, this gold trade's going to continue to work out. If we all think that this was merely just a stoplight for a couple of seconds and we're going to keep moving higher immediately in bond yields, then this gold trade is going to stop working, is kind of the way I'm looking at it. So anyway, I'm long gold right now, or gold miners. I'll just keep moving up my stop, and if I get kicked out, fine. But I think as long as bond yields are stuck here, we've probably got an opportunity in gold. The gold stocks themselves have been pretty euphoric, I think is probably a good way to put that. This is the 1 week returns for these gold miners, and you can see I've only used the ones that have StockCharts technical rankings. That typically eliminates very low price ones or very low volume ones. But you can see in general, they had a pretty strong week. Here's some here at 10, 15%, lots in the 4, 5, 7%. So it was a pretty strong week overall in the gold area. And I think as long as these bond yields, even if they just move sideways, I think we'll find an opportunity for gold to try and catch up here. The real question is, if yields are going to continue spiking higher, and they were getting pretty significantly pushed one way, normally it would take a few months for that kind of euphoria to wear off before it could kind of collect itself and start again. And maybe that's the length of the gold trade. I just think it's an important place to look at. Some of these charts are actually quite nice. If we click on them, you'll see Capstone Mining, which is copper mostly, but it also has gold. That's a pretty nice ascent, holding the 10-week moving average all the way since last April, and just a nice general trend higher. And again, that's copper and gold related. This China Gold International Resources is pushing a bit higher. So you can see all of these things have worked out pretty well. Turquoise Hill, this one closed on new highs today, going back, so new almost 2-year highs. And then when we look at Taseko Mines, these are also industrial metal miners. It's still a very strong chart, pushing up nicely into the top right-hand corner. I do like the industrial mining space. I still think if we're going to do all of this grid build out worldwide and have copper in solar panels and copper for windmills, even once you build the windmills and the solar panels, you need copper to kind of make a collection area to get it into some sort of a battery, bringing the power together. And then you need copper for long distance transmission of that power. So that all leads heavily into the copper and the industrial metals. Steel is one of the most significant components of a wind farm or a solar farm, and it's also significant in the oil patch. So just about any type of energy you're generating, you're going to use a lot of steel. If we're going to build out the infrastructure for the roads and highways, we need steel for that, but we also have a lot of power that goes into that. We use a lot of energy to kind of create all of those components. Cement is a pretty big deal. So all of these industrial metals should probably take another leg higher, and I actually think we don't have enough copper, so getting copper mines approved with any sort of speediness is going to be difficult. Almost everywhere you go, people are saying they don't want a transmission line, or they don't want a copper mine, or they don't want an oil field, they don't want an oil pipeline. So as long as there's big resistance to kind of moving the energy around, whatever form it's in, electrical or liquid, I think we're going to still need all of these metal miners, and silver's a component that can be used in all of that. Gold is used in some places as well, but try not to ignore the big push that's got to go into this industrial metal if we want to move to the electric car. And electric cars have about 6 times more copper than a regular car. So all that leads into these types of metal miners. And one of the things that happens when you mine metals is you might be mining for gold and you get copper. Well, whichever price is stronger or more in demand, they'll quote that, you know, their price of copper is X dollars per pound, and their price of gold, or their price of gold, is X dollars per pound. They'll do whatever makes their books look good to attract investor attention at the time. But you can look at this Sibanye Stillwater gold miner. The SCTR ranking has been held above 75 for, you know, almost 3 years now, 2.5 years. That's an example of a stock pretty much trending higher. Everybody's ignoring it, and yet it's been one of the better performers in the market. Even Apple has a scooter ranking down here around 10%, yet this Sibanye has held up quite well. So from 2 to 20, it's been a pretty nice run over the last 2 or 3 years. Okay, lastly, what I want to cover off is we've got the 3 and 3 to go through. I'm going to jump in and just grab a chart here. Raytheon is a stock that has been it ran up, then didn't do much all through the November, December, January, February, where the market went on quite a run. And it pushed up into the top right-hand corner, and it's getting ready to try and push out here. It put on a nice move, and I'd ask you to go look at Lockheed Martin, Northrop Grumman, General Dynamics. All of those charts are setting up quite nicely. L3 Harris Technologies, really good push on all of those. So maybe give those a chance, go check those out. As well, to end the week, FUBO had a really big volume kick, and we can all see that the chart was doing nothing, took off to the upside, pulled back, made a double top, pulled down, and it's pretty much at support right here, trying to bounce off the 200-day moving average. It's jogged around here for 2 weeks, and then all of a sudden we had some explosive volume in here today. So I haven't heard the news about what might be going on in that, but I think more importantly, the downtrend in momentum looks like it's ready to break, and to me that's a pretty good clue of places to get on board as we start to see a stock turning around at the 200-day. I want to see volume hit. I'd like to see the momentum indicator start to turn up and break some sort of a downtrend. And again, you want the price to respond and probably break this downtrend. So this one looks like a good chart to check in on during the next week. Lastly, what I want to cover off on the stocks is GROW, which is an ETF here, US Global Investors. And what you can see here, look at the volume that came in this week, just as an example. So I'm a little bit worried that there's euphoria kind of building. You can see that for the February top, this also started to get frothy, and then we pulled back and didn't do much. So after a sudden rush into here, we'll just see if this is a little bit too much happiness showing up. And if that's the case, then what we want to watch for is, just making sure that we've moved our stops up, we've protected our positions in case, I'll call it, that divergence that we saw in the advanced decline line data starts to roll over. So other than that, I like the market here. It's been pushing higher. The big thing for all of us is to make sure that as the market works higher here, we want to keep following the clues that volume is laying for us. And so far, everything looks pretty good from the advanced decline, the new highs. We just have a little bit of a gap there. And if that starts to change, we'll exit out of that trade. So thanks for taking the time to join me on the Final Bar. Make sure that you check out some of the other shows on StockCharts TV. I also did the Daily 5 and Market Buzz this week. Thanks again. Have a good weekend. Bye-bye.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.